Good evening. The Indian stock markets weakened ahead of the F&O expiry on Thursday as market players remained wary of near-term prospects due to a spate of headwinds. The undercurrent continues to be jittery over the impact of the proposed GAR-Tax regulations on FII investment through Mauritius and via participatory notes. Barring a brief period in the morning session, the indices were under pressure almost throughout the session. As usual, the selling accelerated in the afternoon with the benchmarks hitting new lows before recovering by the close of trade. Reported clarifications on GAR-Tax regulations and soothing words from FM on the vexed issue may have calmed some frayed nerves. However, the uncertainties do not end here. As a result, market is unlikely to heave a sigh of relief until the matter is settled. The sudden drop in FII inflows in the past couple of sessions is testimony of escalating tension on the GAR issue. The BSE Sensex was down by 135 points to close at 17,122 and the NSE Nifty was down by 48 points to close at 5,194. The India VIX on the NSE ended lower by 0.7% to close at 24.87. Among the BSE sectoral indices, the Consumer Durable Index was the top loser, down by 3.3%, followed by the Banking Index down by 1.8%. The PSU Index was down by 1.6% and the Realty Index ended lower by 1.6% as well. FMCG and Pharma managed slim gains of 0.3% and 0.2% respectively. The BSE Midcap Index lost 0.9% while the BSE Small Cap Index lost 1%. Out of the 50 stocks in the Sensex, notable losers were Hindalco, ONGC, Sterlite, SBI, ICICI Bank, NTPC, Bajaj Auto and Sun Pharma. Among the top gainers were Maruti, Tata Steel, Wipro, ITC, L&T and DLF. Also adding to the pressure was the government borrowing program for first half of FY13. The benchmark 10-year yield inched higher after the centre said that it will sell 65% of FY13 debt by the end of September. The union government plans to raise 3.7 trillion rupees through the bond sales during April-September 2012. The amount is in line with bond traders' expectation of rupees 3.6 trillion to rupees 3.8 trillion. The announcement came after the market hours on Tuesday. In FY12, the government had increased its borrowing amount twice to rupees 5.1 trillion from an initial budget estimate of rupees 4.17 trillion. The centre plans to reduce its budget deficit to 5.1% of GDP from an estimated 5.9% in FY12 that ends on March 31st. The high government borrowings coupled with elevated crude oil prices, limited pass-through in domestic fuel prices, an inflationary budget and high fiscal deficit might prompt the RBI to hold interest rates steady on April 17th policy meeting. On the whole, the undertone in the Indian market remains nervous and a fresh bout of selling is not ruled out. At the same time, upside seems capped from here given the plethora of problems the Indian market is confronting. Volatility may increase before Thursday's F&O expiry. The 200 DMA at around 5,160 levels become a very important level to watch. The cautious trend in India was in sync with the weakness in other Asian markets. In fact, the Chinese market took a severe beating in the late trading, with the Shanghai Composite Index down by approximately 2.5% on worries about the economic slowdown there. Most other Asian markets finished in the red, but the S&P ASX 200 index in Australia rose by approximately 1%. European stock markets were pretty choppy and indecisive today. The Stoxx Europe 600 index was down by 0.1%. The FTSE 100 index in the UK was trading a tad lower after swinging back and forth. Indices in Germany, France and UK were more or less steady. Thank you. Wish you have a great evening ahead.